Hello traders, in our trading video today, we'd like to look at dynamics that traders have to consider when trading the United States dollar versus the Swiss franc currency pair in the Forex markets. We'd like to begin by mentioning that trading the United States dollar versus the Swiss franc currency pair presents a unique set of opportunities and challenges, which means that both novice and seasoned traders must navigate the Forex market with a comprehensive understanding of macroeconomic factors, market sentiment, and geopolitical development that affect the two currencies. The significance of the United States dollar and that of the Swiss franc within the global economy cannot be overstated. To begin with, as the world's primary reserve currency, the United States dollar serves as a benchmark for global trade, finance, and also investments. It reflects the economic health of the United States, which is a global superpower with a robust economy that's driven by diverse factors, including but not limited to technology, finance, and consumer markets. On the other hand, the Swiss franc is often viewed as a safe haven currency. Typically, Switzerland's long-standing political neutrality, finance or strong finance sector, and stable economy usually make the Swiss franc a go-to asset in times of market volatility as well as during times of economic uncertainty. When examining the United States dollar versus the Swiss franc currency pair, it is essential for traders to understand how these two currencies interact. Historically, the United States dollar and Swiss franc exhibit a negative correlation, particularly against other major currencies such as the euro. This inverse relationship means that whenever the United States dollar strengthens, the Swiss franc tends to weaken and vice versa. This correlation is driven by the safe haven status of the Swiss franc, which typically means that during periods of global risk aversion, investors often flock to the Swiss franc, driving its value up against the United States dollar. Conversely, when global markets are stable and risk appetite is high, the United States dollar gains strength, they are in a way reflecting the confidence in the United States economy. Traders must therefore pay close attention to the macroeconomic factors that influence the United States dollar and the Swiss franc. For the United States dollar, some of the key drivers include the Federal Reserve's monetary policy, economic indicators such as the GDP growth, employment data, and inflation rates, as well as broader global economic trends. Typically, the Federal Reserve's decision on interest rates particularly have a direct impact on the value of the United States dollar. Higher interest rates generally attract foreign investment, thereby boosting the demand for the United States dollar. Conversely, low interest rates often lead to a weaker dollar as investors seek higher yields elsewhere. For the Swiss franc, the Swiss National Bank, that is, the monetary policy of the Swiss National Bank, is crucial. Unlike the Federal Reserve, the Swiss National Bank has traditionally maintained a more interventionist stance, especially in its efforts to prevent excessive appreciation of the Swiss franc, which could, in one way or another, harm the Switzerland's export-driven economy. The Swiss National Bank's interventions, which include setting negative interest rates and intervening directly in the foreign exchange markets, usually have an aim to keep the Swiss franc from becoming too strong. Traders must therefore keep a close eye on Swiss National Bank's statements and actions, as unexpected interventions can lead to significant volatility in the United States dollar versus the Swiss franc currency pair. Geopolitical events also play a significant role in trading United States dollar versus the Swiss franc currency pair. We have to mention that Switzerland's geopolitical neutrality often makes the Swiss franc a refuge during times of international tension or international conflict. For instance, during the Eurozone debt crisis or the uncertainty surrounding Brexit, the Swiss franc appreciated as investors sought safety. Conversely, during times of global economic optimism, the United States dollar often strengthens as investors move away from safe haven assets in search of higher returns. Therefore, traders should be keenly aware of geopolitical development that might influence market sentiment, and by extension, the United States dollar versus the Swiss franc currency pair as they trade the Forex markets. In addition to these fundamental factors, technical analysis are an indispensable tool for traders in the United States dollar versus the Swiss franc market, as well as for other currency pairs. What we mean is that price action, support and resistance levels, moving averages, and other technical indicators which can provide valuable insights into potential entries and exit points have to be put in consideration. For instance, traders have to note that the 50-day and 200-day moving averages are often used to identify long-term trends, while RSI can signal overbought or oversold conditions. Furthermore, Fibonacci retracement and MACD are also popular tools among traders to identify potential reversals or continuations in price trends within this currency pair, as well as other currency pairs. One effective trading strategy when trading in the United States dollar versus the Swiss franc is the carry trade, although it has become less popular in the recent years, and this is due to low interest rate environment in both the United States and Switzerland. A carry trade typically involves borrowing in one currency or in a currency with a low interest rate, which in this case would refer to the Swiss franc, and investing in a currency with a higher interest rate, which in those cases would refer to the United States dollar. The traders profit from the interest rate differential. However, this strategy carries significant risk, particularly if there is a sharp reversal in the exchange rate, as the Swiss franc tends to appreciate rapidly in times of market stress. Another strategy that traders can factor in trading the United States dollar versus the Swiss franc currency pair is to trade based on divergence in monetary policies between the Federal Reserve and the Swiss National Bank. For instance, if the Federal Reserve is in a tightening cycle, raising interest rates while the Swiss National Bank maintains a dovish stance with low or negative rates, this divergence can create opportunities for traders to long the United States dollar against the Swiss franc. Conversely, if the Swiss National Bank were to signal a shift towards tightening, perhaps in response to inflationary pressures, traders might consider shorting the United States dollar versus the Swiss franc currency pair. We also have to mention that traders have to consider the broader market environment whenever they are trading the United States dollar versus the Swiss franc. For instance, in a risk-on environment, this is where investors are more willing to take risks. The United States dollar might appreciate as capital flows into United States assets such as the equities and bonds. In contrast, in a risk-off environment, that is, where investors are more risk-averse, the Swiss franc is likely to strengthen as it is perceived as a safe asset. Moreover, the impact of the commodities prices, particularly gold, should not be overlooked. Switzerland is one of the world's largest gold trading hubs, and Swiss franc often exhibit a positive correlation with gold prices. When gold prices rises, the Swiss franc tends to strengthen, reflecting its status as a safe haven asset. Conversely, when gold prices fall, the Swiss franc may also weaken. Traders who monitor gold prices alongside other macroeconomic indicators can gain an additional layer of insight when they are trading the United States dollar versus the Swiss franc. It is important to consider the role of market liquidity when trading the United States dollar versus the Swiss franc. The Swiss franc, while being a major currency, does not have the same level of liquidity as the United States dollar. Typically, during periods of high market volatility or low liquidity, the United States dollar versus the Swiss franc currency pair can experience sharp and erratic price movements. As such, traders should be mindful of these conditions, particularly when trading around major economic releases or geopolitical events where liquidity can dry up and lead to significant slippage. In terms of risk management, traders should employ strategies such as stop loss orders and position sizing to mitigate potential losses. Given the volatility that can rise in the United States dollar versus the Swiss franc currency pair, it is essential to set appropriate stop loss levels to protect against adverse movement. Additionally, using position sizing strategy that takes into consideration or into account the trader's overall portfolio and risk tolerance can help prevent overexposure to any single trade. We'd like to finalize by mentioning that traders should be aware of psychological aspects of trading the United States dollar versus the Swiss franc currency pair. Given the pair's sensitivity to global risk sentiment, it can be prone to sudden and sharp movements, which means that traders need to maintain discipline and avoid emotional decision making, which often lead to poor trade execution and increased risk. Typically, developing a well-thought-out trading plan backed by thorough analysis and a clear understanding of the factors that drive the United States dollar versus the Swiss franc currency pair is critical for long-term success when trading the United States dollar versus the Swiss franc, as well as trading the entire Forex market. Thank you for watching, and let us interact again in our next trading video.